Commercial paper is a short-term unsecured promissory note negotiable and transferable by endorsement and delivery with a fixed maturity period. It is issued by large and creditworthy companies to raise short-term funds at lower rates of interest than market rates. It usually has a maturity period of 15 days to 1 year. The issuance of commercial paper is an alternative to bank borrowing for large companies that are generally considered to be financially strong. It is sold at a discount and redeemed at par. The original purpose of commercial paper was to provide short-term funds for seasonal and working capital needs. For example, companies use this instrument for purposes such as bridge financing. Suppose a company needs long-term finance to buy some machinery. In order to raise the long-term funds in the capital market, the company will have to incur flotation cost. Flotation cost means floating of an issue or brokerage, commission, printing of applications and advertising, etc. Funds raised through commercial paper are used to meet the flotation cost. This is known as bridge financing. Call money. Call money is a short-term finance repayable on demand with a maturity period of 1 day to 15 days used for interbank transactions. Commercial banks have to maintain a minimum cash balance known as cash reserve ratio. The Reserve Bank of India changes the cash reserve ratio from time to time, which in turn affect the amount of funds available to be given as loans by commercial banks. Call money is a method by which banks borrow from each other to be able to maintain the cash reserve ratio. The interest rate paid on call money loans is known as the call rate. It's a highly volatile rate that varies from day to day and sometimes even from hour to hour. There is an inverse relationship between call rates and other short-term money market instruments such as certificates of deposit and commercial papers. A rise in call money rates makes other sources of finance such as commercial paper and certificates of deposit cheaper in comparison for banks raise funds from these sources. Certificate of deposit. Certificate of deposits are unsecured, negotiable, short-term instruments in bearer form issued by commercial banks and development financial institutions. They can be issued to individuals, corporations, and companies during periods of tight liquidity when the deposit growth of banks is low but the demand of credit is high. They help to mobilize a large amount of money for short periods. Commercial bill. A commercial bill is a bill of exchange used to finance the working capital requirements of business loan. It's a short-term negotiable self-liquidating instruments which is used to finance the credit sales of goods. When goods are sold on credit, the buyer becomes liable to make payment on a specified date in future. The seller could wait till the specified date or make use of bill of exchange. The seller of the goods draws the bill and the buyer accept it. On being accepted, the bill becomes a marketable instrument and is called a trade bill. These bills can be discounted with a bank if the seller needs funds before the bill matures. When a trade bill is accepted by a commercial bank, it is known as commercial bill. Capital market. The term capital market refers to facilitate and institutional arrangements through which long-term funds, both the debt and equity, are raised and invested. It consists of a series channels through which savings of the community are made available for industrial and commercial enterprises and for the public in general. It directs these savings into their most productive use, leading to growth and development of the economy. The capital market consists of development banks, commercial bank and stock exchanges. An ideal capital market is one where finance is available at reasonable cost. The process of economic development is facilitated by the existence of a well-functioning capital market. In fact, development of the financial system is seen as a necessary condition for economic growth. It is essential that financial institutions are sufficiently developed and that market operations are free, fair, competitive, and transparent. The capital market should also be efficient in respect of the information that it delivers, minimize transaction cost, and allocate capital most productively.